Well, as we set up for the open this morning, we are looking at a negative open after the negative close that we had yesterday following the Fed minutes. Let's bring in Alli McCartney, UBS Private Wealth Management Managing Director. Alli, thanks for being here. You know, we were having a bit of a discussion earlier about what investors are worried about right now, and they've got their pick, right? You've got some increasing concerns about growth from China. You've got the Delta variant. You have what we heard from the Fed yesterday in terms of tapering. What do you think is driving most of the concerns? And do you think in the end, you know, markets are going to overcome them and continue to push higher?
The short answer is yes. I don't think the concerns have really changed considerably all that much over the last number of years. They've just, last number of months. I think really what's happened is sort of the order of importance and information. So the Delta variant and the numbers that we're seeing growing fourfold in the US and even larger outside has existed again since February of last year, March of last year. The question is whether the Delta variant continues to have additional curbs of mobility that affect the economics and spending of this country and affect the pace at which, let's say, the emerging markets in Europe can continue to recover as well. The Fed, again, that has been with us since the very beginning. How accommodative is our Federal Reserve going to be? What is fiscal policy in the U.S. going to look like? And is the rest of the world going to echo that? Definitely some concerns around that, although I would argue that those concerns have eased with the increased transparency that the Fed has been giving us and with, you know, a path that looks like maybe a December beginning of or announcement of taper, which goes into the beginning of next year, 120 million less of buying a day. And then the other question, billion of buying a day. And then, you know, the path of interest rates. And I think that there is and has been a lot of telegraphing from the Fed that looks like a 2023 event. And we agree that that's the case. They seem to be, again, commenting on the market. The minutes reflected this, and we expect to continue to see that in the Jackson Hole conversations, that inflation is under control and that they are getting towards their progress on the jobs numbers. Although remember with, in past recessions, in past contractionary periods, the job market has taken about 28 to 29 months to recover. And that was when it was, quote unquote, a normal recession or shrinking of the economy, as opposed to some crazy, inflicted economic coma event. So that's going the right direction. It may not be going as fast or as sort of equally as the Fed would have liked, but that continues to happen. And then you have issues around some of the data we've seen. We saw slowing growth from China. We saw some sales numbers for July that gave people a little pause. But again, we think all of this are sort of normal ups and downs of what happens once you reach the peak of the peak. And so we expect growth to continue. We see a super strong consumer, especially with the back to school. We see a super accommodative Fed. And fixed income is just not a place that we can put client money to the extent we have in the past. So you still have that conversation around TINA. There is no alternative pushing investors, individual and institutional, into taking risk in order to keep up with inflation. And that's a great environment to invest in equities.
Well, Alli, talk about peeking. I see your cute pup behind you peeking into the shot. That was very, very cool. The puppy looks bullish. I think they're liking your call, Alli. But what you mentioned on the market weakness here, does that mean, investors are in fact getting a little more nervous? Should they be buying on this weakness?
So yes. So, I'm personally buying, and I'm buying for clients on any weakness. We ourselves, we've had an 18% year in the market. We are up over in some, market measures 100% from the bottom. So there's no way to argue that this is an uncomfortable time to invest. It feels uncomfortable. We've had 200 days of highs in the last number of months. But again, if you go back to that conversation around where else do you put money and how do you continue to construct and build a portfolio in such a bizarre environment, and one where you're also going from a 30-year bull market in bonds to one in which it's going to be quite challenging as interest rates go up, you simply have to invest. If you look at the street and some of the numbers and the frequency of revisions, not only to individual stocks, but to price targets for year-end 2021 and then into 2022 and 2023. You're starting to see numbers in the S&P. We have a 4650 for 8 months hence. I know Goldman came out with a 4750. So there is absolutely still upside. And, there's so many things that are supportive of that. Fed continued, involvement in the market and support thereafter. Vaccination campaigns, we have booster shots that were discussed yesterday. We have the rest of the world increasingly getting vaccinated. We have an environment in which we believe at UBS, using UBS Evidence Lab, our proprietary AI technology, that you're going to see a 30% increase in the amount of money going to dividends and buybacks for the S&P 500 over the next number of actually the next 12 months. So all of those things are saying that there is still room to move in the equity market, especially in cyclicals.
All right, welcome back to Yahoo Finance Live on this Thursday morning. Talked a little bit earlier about Nvidia's latest quarter. Let's talk not only about this quarter, but about where the chip cycle is at more broadly here. Let's bring in Anand Srinivasan, an analyst with Bloomberg Intelligence, for more on all of this. Anand, thanks so much for jumping on the call this morning. Let's just start with how you guys are thinking about where we're at in this cycle, right? We had heard a lot about a chip shortage, about the inability for certain suppliers. The auto industry certainly had a chip problem. Where do you see the cycle as of today, and what has the most recent round of earnings told you guys?
Yeah, so that's a great question. Thank you for having me on. Look, our view of the chip cycle is that this shortages and the demand spikes have been a long time coming. The chip industry has had historical patterns of excess demand and then excess supply. And as a result, there's been these wide swings. Even though the CAGR, or the compound annual growth rate in the industry, is somewhere in the mid-single digits, you've had these sine waves around that slope of the line that are excessive. And what the industry has done over time is to compress supply expansion and crimped the potential price swings that come along with the oversupply with the industry. And as a result, we think that this has led to more steadiness and dampened volatility in the semiconductor industry, and we think that is here to stay. As a result, when the chip shortage happens, we think this has been a long time coming, and all it's going to do is extend demand, and it's going to compress that sine wave. So we think demand patterns are going to probably have to stick around a little longer because supply isn't coming online anytime soon. So we think that it's going to be a more steadier demand pattern through the remainder of 21 and potentially into 22. So the translation of that into smaller semiconductor consuming industries, autos, industrials, communications, infrastructure, energy industries, all of that is going to see sort of demand sort of lower prioritized, and it's going to have to wait till 2022. And prices are going to have to go up, and that's probably going to readjust demand a little bit as well. The timing of it is a little odd, right? This is the seasonally strongest period of the quarter, but the problem is that because it's the seasonally strongest period for semiconductors, all of the demand is going to be prioritized for PCs and handsets, which occupy, give or take, about almost 70% of semiconductor consumption. So this is sort of a darned if you do, darned if you don't for the semiconductor industry. But in our view, it's going to extend out the demand patterns and extend out the sustainability of the semiconductor cycle.
That's really interesting, and I want to continue on that point for a moment. I know that you came on to talk about Nvidia, but I want to pick up on that. And on the Nvidia point, the CEO Jensen Huang said on the call, demand is going to outstrip supply for some time. So it's interesting because we were getting some early indications from the automakers that the shortage was abating, but now we hear from a Toyota, we hear from Ford. It's back, right? It's still having an effect on production, both of them cutting production. So it sounds like from what you're saying that that's going to continue to happen, or at the very least, we are going to see these waves for the lower priority industries for quite some time. Yeah,
so one of the things that's a good way of thinking about it, Julie, is we're capacity you don't turn on a switch in the semiconductor industry and then, you don't have this flood of capacity. We're trying to expand capacity, but the semiconductor industry is also very cognizant of the fact that, look, not all of this demand may be real. Some of this may be double ordering from a panicked buyer. And as a result, they don't want to turn on too much supply and hurt their own profitability and pricing over the long term. So, there's some of that reticence from the semiconductor industry. On the flip side, from a demand perspective, there is a sustained high demand from PCs, from smartphones, from the data center, both from the cloud and the corporate IT buyer, which is seeing solid demand. And if you look at industrials, if you look at autos, and if you look at the other industries, they're smaller pieces of the pie. Autos, for all of the drama and the noise that it makes, is less than 10% of semiconductor consumption. So, and this is partly their own fault when they cut supply or cut production in 2020, right? So, in all fairness, we just see this demand extending over a longer period of time, and we think higher prices are probably here to stay in the early part of 22 as well.
So just quickly then, Anand, let's bring it back to Nvidia, right? All of this would seem to bode well for Nvidia. Data center business, very strong for the company in the quarter. It's got the gaming business, the crypto business as well. Is that the only suspense here sort of over the mix going into the coming quarters?
Absolutely. Look, I mean, they've got both their engines firing, which is the gaming business, and a wider demographic of people are becoming gamers, particularly PC gamers. And Nvidia is the leader of making systems to solve that particular demographics demand. The other part of it is AI, and AI, as we well know, is proliferating across a variety of workloads, both in the cloud as well as in corporate IT, and they make the best chips for both AI training and AI inference. And so both of those are long-term structural demand drivers, and that's going to drive demand for NVIDIA. The fact that you have these spiky patterns from a seasonal perspective, and as a result, you're going to get it in excess of supply from time to time, but in the long run, NVIDIA is a fantastic a clean structural growth story for multiple years to come, in our view.
All right, we'll leave it there. Anand Srinivasan, analyst with Bloomberg Intelligence. I appreciate the time this morning. We'll be in touch.
Take a look at shares of Petco Health and Wellness Company, ticker symbol WOOF, getting a boost today after the pet care company reported second quarter earnings, beating on both the top and bottom lines. Joining us now is Petco CEO Ron Coughlin. Ron, great to have you back on the program, and a record quarter for you all in terms of revenue, also stellar comparable same-store sales here, or comps. You raised guidance, and I heard you on that conference call, a lot of optimism about the momentum here with that pandemic pet boom going forward. Would love to hear what is underpinning that confidence for you.
Yeah, we feel really good about the numbers, as you said, 20% comp, strong bottom line performance. We added roughly 1 million net new customers in the quarter, and that'll power us through. But more pragmatically, we ended the quarter with strength, and we have strength going into Q3, and we have the heightened comp in those periods where we had higher sales last year. So lapping those with strength was very important litmus test for us, and we saw strength at the end of Q2, and we're seeing strength out of the blocks in Q3.
Yeah, you mentioned a litmus test for you all, and I know the digital growth, it was still there, still quite strong, though it did moderate, and a lot of focus has been on, the stores and how those were going to do, and you're mentioning just the comp growth. What are you all seeing in terms of stores, in terms of that strategy? What is working for you? It seems to me that you all are playing to the strength of the store footprint, the pet care centers, if you will.
Yeah, so there's two dynamics. First, there was a theory that people would go online and not come back, and the great news for us is that's not what happened. They came back in droves. So our pet care centers were up 17%, and people love having those experiences, whether it's getting groomed, whether it's going to a vet, whether it's getting trained, or getting advice on what's the best food for your pet. They love that experience. But the other critical part about our pet care centers is 87% of our e-commerce e-commerce orders get fulfilled through pet care centers. And that means it's faster to the customer and lower cost than our online competitors. And that to us is the definition of competitive advantage.
So you just mentioned, I think you said 87% of those e-commerce orders getting fulfilled. I heard you on the conference call, and I heard it briefly, but it was about the fresh and frozen food category, and you all seen tremendous growth there. Talk to us about that, and what is driving this trend? I imagine pet parents treating their fur babies here.
Yeah, so there's absolutely a trend. It's supposed to go from 1 billion to 4 billion by 2025. We're the leading retailer in the fresh frozen. And at the end of the day, it's the humanization of pets. And, in terms of a tailwind, Gen Zers and millennials are even more likely to follow this humanization trend. So fresh frozen is a trend that's going to be here for a long, long time. We're taking a leadership position. We expanded our pet care centers that have just food for dogs, but we also have a national footprint with Instinct and Fresh Pet. So we have a great portfolio, and as I said, we're leading in the space.
And I would imagine maybe the stores help you compete against some of those, direct-to-consumer pet companies out there when it comes to products like this.
Well, you think about it, right? If you're going to ship from a distribution center, you're going to have cardboard, you're going to have to insert cooling into that, and then shipping that to a customer, it is very, very hard to make money. If you think about what happens for me, my fish and sweet potatoes gets packed in the store in Del Mar next to my house in a paper bag and gets dropped at my house. We don't have the FedEx charge, we don't have the cooling charge, and it's right on my doorstep at much less cost and obviously less time. So we think that our same-day delivery capabilities are a particular advantage on fresh and frozen.
Let me ask you about inflation. This is a big topic that we're asking a lot of folks who are CEOs of retail companies. How are you all thinking about mitigating some of the risks as it relates to inflation, and what are you seeing across your supply chains?
Yeah, so there's two buckets, right? One is from vendors and two is costs in your logistics. From a vendor standpoint, we have seen their input costs have gone up and some prices passed on to us. It's about 20% of our SKUs, and we've seen success in passing that through. Pet's a very resilient category. And in aggregate, we've seen no unit degradation as we've taken that price. So at the end of the day, it'll be a positive for our business. From a logistics standpoint, there have been some increases, but as evidenced by our financial performance, we were able to offset that, and our guidance includes any envisionable increases as well.
One of the standout points in your earnings release, Ron, was the recurring revenue. Recurring revenue up 60%. You all are adding more customers to this. Talk to us about the growth story here. What is kind of your broader ambition? Are you trying to build, what are you trying to build out with Petco when it comes to these more predictable recurring revenue customers?
Yeah, I am so happy about this. 50% increase in number of recurring revenue customers and 60% increase in the revenue from recurring revenue customers. And that creates stickiness and that creates long-term predictability in our earnings. And over 50% of our e-commerce revenue is from recurring revenue customers. So whether it's our repeat delivery offer, whether it is our Vital Care membership program, whether it's insurance, whether it's Pup Box, those programs are all scaling rapidly, and it's just great for our business. And those customers spend more. Our Vital Care customers spend 2.5 to 3 times more than our average customer. So it's just great for our business.
Ron Coughlin, CEO of Petco, thank you so much for stopping by Yahoo Finance Live today.
Thanks for having me. Always a pleasure. And say hi to Winston for me.
Will do.
Well, leaders from nearly 200 countries are gathering in Glasgow this fall to come up with a collective plan to tackle climate change. The UN conference known as COP26 will call on countries to get ambitious targets to reach net zero greenhouse gas emissions by the middle of this century. And for the biggest emitters, like the US, there is added pressure to financially help developing countries develop their low carbon footprint. To discuss that, let's bring in Jake Levine. He is U.S. International Development Finance Corporation's Chief climate officer, a new role here at the agency. We've also got Yahoo Finance's R.T. Swaminathan joining in on the conversation. Jake, it's great to talk to you. For those who are not familiar necessarily with what the DFC does, it's the government arm that helps develop these, help finance private development in developing countries. A lot of questions around the U.S. commitment in helping a lot of the poorer countries reach these broader goals. How do you prioritize these projects by region and specifically by, the types of projects the U.S. is looking to finance?
Sure. Thanks, Akiko. And hi, Arthi. It's great to be with you guys to talk about this important subject. A lot going on in the lead up to COP26, and we're going to be a big part of that. Just to give you a little bit of context, the DFC, the Development Finance Corporation, is basically America's development bank. We were authorized in 2018 under legislation in Congress called the BUILD Act to invest up to $60 billion in low to middle income countries around the world. And we have a whole array of financial tools to do that. We work with debt financing and project finance. We do equity investments, both in direct equity investing and also through the use of funds. And we now really importantly have a new technical assistance capability, which particularly when we're talking about climate in developing economies is critical to the work of actually ensuring that projects can become feasible and can meet the various sort of technical capabilities that we need them to meet, whether it's an energy project, transportation, buildings decarbonization, industrial nature-based solutions, sort of across the gamut. And in terms of what we're doing on climate, the Biden administration has really focused its efforts overseas in ensuring that the U.S. is playing a leadership role, both within the context of the UNFCCC and the COP26 meetings coming up in Glasgow, and also more broadly through the G7 and the G20. DFC is sort of taking the lead on that climate piece. We have committed to investing at least 1/3 of our overall portfolio in climate-linked investments. We committed to being net zero as a financial institution by the year 2040, which is the most ambitious net zero commitment of any of the major economies' development finance institutions. And we've rolled out, as I sort of alluded to earlier, this key technical assistance facility, $50 million over 5 years. Happy to go into more detail on any of that.
So Jake, going back to the question of how you pick your priorities when you've got this grand goal, really, I mean, there's a long list of projects that need to be pursued. How big of a factor does the competition with China play into that at a time when they are investing billions of dollars in emerging economies?
Well, it's important. I mean, look, the DFC is very affirmatively seeking to provide an alternative to the type of financing that China provides through its Belt and Road Initiative. China has engaged in a certain development finance practices that are more in line with the type of practices that you see coming from authoritarian governments. You see other recipient governments oftentimes pressured to take on this type of sort of debt trap financing. And the US government, working with its partners to the G7, is providing a values-based alternative focused on sustainability, not just on climate sustainability, but on financial sustainability, and focused on making investments that are ultimately good for the countries where we are providing investment. So that includes bringing up basic environmental and social and labor standards in line with US and American values and the types of values that we don't see coming from other types of investors like China and others.
Jake, for a developing country, when they're considering costs, there is tendency to focus on something that's established, like coal, fossil fuels. But how has that conversation changed? Are countries more receptive to receiving DFC, as you move into this new administration?
Absolutely. And, this also plays into this question of sort of where are we prioritizing our work? And as you're likely well aware, the US is driving a number of really positive, both bilateral and multilateral conversations in the context of the UNFCCC. So our discussions with other nations such as Indonesia, South Africa, Brazil, India in particular, in terms of their specific transitions, energy transitions away from heavily polluting fossil energy and towards clean energy. And when we come into the market, it creates sort of the possibility for the private sector to follow on. This is core to our mission, is to be able to de-risk investments that would otherwise provide too high of a risk for the private sector to want to follow on and crowd in terms of our investments. And we're now seeing that the market is clearly headed towards clean energy. I think on the previous segment, you talked about on a previous segment, you had talked about just the record amount of investment that we're seeing into climate, whether that's on the venture side or private equity or from institutional investors. And what we're focused on doing is sort of accelerating that transition in the markets where it's hardest to do and where it's been the slowest so far because of various market-specific risks.
And just linking back to the developments that are happening with regards to Afghanistan, you mentioned the Belt and Road. There is a very key part that Afghanistan has to play because of its proximity to Pakistan, which is a big partner for China. How is the DFC thinking about these developments? I know that, obviously there might not be investments there, but what is going on with the thinking there? I'm curious.
DFC, we are focused on providing development value in the toughest environments where it is most difficult to provide private financing. And so a lot of times you see that happening in countries that have been navigating really incredibly the hardest, most challenging problems, such as conflict, migration, civil war. And we look forward to the opportunity to evaluate specific transactions that can help drive the American development agenda in those countries, and particularly around the world in the most difficult situations.
And Jake, finally, as we look ahead to COP26, there is sort of this nagging question about U.S. credibility on the issue of climate. The UN has consistently pointed out that $100 billion commitment that was placed by developed countries back in 2009, that commitment still hasn't been met. What do you say to those countries who say, how do we know that the U.S. is all in? And how do you rebuild the U.S. credibility on this very issue?
It's a great question. It's a really important question, Akiko. And I just want to reassure some of those countries and partners and allies that this is a central area of our focus. We are working day in and day out to ensure that the developed economies, including with the US in the lead, can actually keep that commitment that we made in 2009 at the Copenhagen COP, and that we are working hard to accelerate the degree to which we're able to provide financing and help to reach that $100 billion goal. It is key, as you note, because in nations around the world that are still developing, they're experiencing a convergence of both coping with the impacts of climate change and also experiencing their own emissions on the rise. And so it's incumbent upon countries like the United States and our partners in the OECD to be providing financing to help navigate that transition and support the work of developing economies.
Well, Jake, we hope to keep the conversation going with you. Jake Levine, U.S. International Development Finance Corporation Chief Climate Officer, and our very own R.T. Swaminathan as well. Thanks.
Welcome back to Yahoo Finance Live. I'm Jared Blickby. Well, time to talk about education, specifically inequality in higher education. For that, we have author of The State Must Provide, and that is Adam Harris. And we also have Yahoo Finance's R.T. Swaminathan. And thank you both for joining. Adam, I want to get your take on what led you down the path to write this book. We had an interesting conversation over the break here. Just kind of give us a little background there.
Yeah, so I attended a historically Black college, Alabama A&M University in Huntsville, Alabama, and there's a predominantly white institution, maybe about 10 minutes away from A&M. And there, I had fantastic professors. I had a fantastic experience at A&M, but there were little things that I noticed when I visited UAH, right? I saw that they had new buildings. If there were potholes, they had been fixed. They had, their library was open for longer. And on top of that, right, they had a larger endowment than my own institution. It was interesting to me in part because UAH opened 75 years after Alabama A&M had opened, right? So I was wondering really why there was that disparity in resources for my own institution compared to this newer institution not that far away. And what I learned is that my experience there actually was not anomalous in higher education. In fact, is sort of the norm, where Black students are more likely to attend institutions with fewer resources to help them be successful in college. And so that was really the genesis and the root. And I really wanted to explore the realities and why that is.
Adam, when you look at the history of higher education, would you say that it's structurally and fundamentally racist? Would you go as far as to make that statement?
I think the foundations of higher education, right? So from the first Morrill Act in 1862, right, where the federal government, had the largest investment it's ever really made in higher education, providing states with land expropriated from Native Americans that the states could then sell in order to fund an institution, right? Black students could not attend those institutions. They were attended almost solely by white men for the first 30 years of their existence. And then when those institutions needed more money, right, they went back to the federal government, and the federal government said, okay, well, you at least need to create separate institutions for Black students. And so, just thinking about that base, thinking about the reality that Black students were shut out of higher education writ large, and that, that was an intentional action, right? The environment was shaped in such an intentional action. You look at a state like Mississippi, where Alcorn State, right, founded in 1871, historically Black college, was supposed to receive a guaranteed $50,000 appropriation for 10 years from its founding. In 1875, that appropriation was reduced to $15,000. In 1876, it was reduced again to $5,500. Meanwhile, the University of Mississippi is saying, we would rather close. Our faculty would resign if we were to enroll a Black student. So there are, some very actively racist underpinnings to our higher education system now. And I think that the way that we understand America's higher education system is that it's the greatest in the world. But I think we have to grapple with that original legacy.
So Adam, how do you break this cycle? You're highlighting some of these inequities that have been built over a period of decades. And if you look at endowments, for example, in Ivy League's private institutions, so much of that is often driven by alumni who have come out, who have been successful, who have become wealthy. How do you break this cycle that you're talking about to make for a more even landscape?
Yeah. And it's difficult, right? So where you have a place like Johns Hopkins, where Michael Bloomberg gave more than $1 billion in a single donation. Meanwhile, my own institution, Alabama A&M, just yesterday received its largest ever single donation, and it was $2.2 million from a young alumni. And so there is that sort of disparity in philanthropic giving. But I think that, if people were to sort of look to philanthropy as the solve for this generational kind of historical discrimination, ongoing discrimination, it's going to be difficult to actually have an equitable system from that. I think that as the state and federal government sort of created and shaped these environments of inequitable education, I think that the state and federal government have responsibility to address it, right? Kentucky, Berea College was an integrated coeducational institution from 1855, and it was only broken apart by intentional state action known as the Day Law of 1904. And so I think that we really have to look at the ways that states have really stymied Black education and address that role that they play in fixing it.
Just following up on the massive gap in terms of how much Black students owe as compared to white students when it comes to student loan debt. We spoke with Ayanna Pressley, the Congresswoman, a couple of days ago, where she said cancellation is one of the ways we can make this more equitable. What do you think about that?
That's a really good point. And if you look across where student debt is held, right? Black students are more likely to take on student debt. They're more likely to take on more student debt, and they're more likely to default on that debt after they leave college, whether that's with a degree or without a degree. So it kind of puts them in a very difficult position. And I think debt cancellation, especially for people who took on some debt, didn't end up finishing their degree, but now they're saddled with, either $5, $6, $7, $8, $10,000 in debt. Debt cancellation will go a long way towards helping them kind of get out of poverty, to help them, establish a more sound financial base with which to move forward from. And maybe they can go back to college after that, right? That's why oftentimes when you hear the debt cancellation conversation, you also hear the tuition-free college conversation as well, because if you cancel debt and you still have an inequitable loan system, then it's going to be very difficult for people to get forward.
The beaten down travel industry appeared to be on the upswing this summer, but a surge in new COVID cases could threaten the bounce back. Joining me now is Frederic Lalonde, CEO and co-founder of the travel app startup Hopper. Frederic, great to see you. And I was looking at Hopper's financials, and wow, I mean, revenue already up 100% versus your pre-pandemic quarter. I'm curious what impact this new wave of COVID is having on your business right now.
Yeah, that's interesting. Definitely the Delta variant is concerning. There's some areas like Florida where we're seeing high caseloads, but travel itself globally and at Hopper is really in what we call a super cycle. So there's a lot of pent up demand. Consumer saving rates are as high as we've ever seen them, and people are frustrated. They're booking travel. So regardless of the fact that we're seeing some disruption in some of these markets, we're basically continuing to grow. We've had some of our strongest days ever actually this week in terms of travel sales and booking. One thing that we are noticing, though, is that there is a surge in demand for our disruption protection products. So Hopper sells travel, but we are really fueled by all of our financial products. And one of them is a product that prevents disruption. So if you're disrupted, we basically pay for a new flight for you. And the purchase of our disruption and rebooking products is up 50% since the beginning of the year. So people are traveling, but they're also very nervous.
So what you're offering folks is sort of this travel insurance, if you will, through your fintech products. Talk to us about how much that typically costs, because it sounds like people are willing to pay a bit of a premium to protect their travel.
Yeah, what we do at Hopper, and this is why we've been so successful, we actually doubled our revenue during the pandemic on the same kind of demand slump as our competitors. But we have a massive big data stack and AI technology that dynamically prices the risk of the future. So if you think of when Hopper was started, we forecasted future airfare. Today, we use that same data advantage and technology to basically insure people against all sorts of things. One of our most popular products is what we call price freeze, where we freeze the price, a low price today. And if the price goes up, you actually don't pay the difference. We do. But we do this for changeability and disruption. And so the answer is, it really depends if you're booking an $89 flight or a $2,000 flight. It's usually a nominal amount, anywhere between 10 to 15%. But at the end of the day, what we've seen during the period we're in now, but even the bulk of the pandemic, the first and second wave, the more disruption there is, the more people tend to lay on these financial products as they're purchasing travel.
Yeah, definitely an interesting consumer switch or habit, if you will, that continues to be growing throughout the pandemic. I want to get to your recent raise, $175 million. That's no chump change there, Frederic, in your latest round of funding. I believe you've raised something like $600 million. Is that correct?
Yep, just a bit short of that, about 580.
Wow. And so now Hopper is valued at $3.5 billion. Talk to us about how you're going to use the latest funds that you were able to raise.
Yeah, so the focus that we have right now is completely on growth. On one side, we have what we refer to as the marketplace, but it's basically the Hopper app that everybody has used. And so we have over 60 million downloads. We're easily the largest travel app in North America. Some of our competitors globally are larger, but in terms of mobile installs, we tend to be the biggest ones. And as we continue to grow, we're seeing demand. And we'd also announced a raise at the beginning of this year, so we have quite a bit of cash on hand. One of our focuses for this is international expansion. So So we're getting ahead of the border reopenings. To be clear, I think we have at least another year of disruption with COVID, but gradually, as the vaccines roll out, we're seeing some stability in international travel. So we've opened material presence in Latin America, Europe, and we're very interested in Asia, amongst other places. The other part is a whole lot of category expansion. So you're going to see us get into homes, activities, basically everything that a traveler would want to purchase, we're going to try to offer in the app in the Hopper way. The other half of our business now is something we launched actually at the beginning of the year with the Capital One funding announcement, is what we call Hopper Cloud. So our fintech products have been so successful in our marketplace that we've started to make them available as a cloud service. You can think of Amazon's AWS as a comparable. So other companies that sell travel, that have travel reward programs, are using our financial products to increase their revenue, help their customer experience. And we're offering that as a B2B offering. Both parts of our business, the growth is on fire. We're seeing high triple digits everywhere. The business is basically doubling every quarter. So it made a lot of sense to bring on investors to help us support that growth.
And one of the things I know you're doing to go along with your B2B efforts is you are white labeling some of your products, working with Capital One. You recently had a deal with Amadeus. I guess that brings in, is that going to bring in car rentals to the platform?
So we have car rentals in the app today on iOS, and it's rolling out in Android. And yes, you're going to see us bring basically every important travel category into the app. And the cloud component really is two offerings. The reason people come to it is because of the financial services, the ability to offer our price freeze. And one thing that's important is we take on the financial risk. As I was explaining, we pay out the difference. We've gotten incredibly good at pricing risk algorithmically in travel, and it just allows other companies to benefit from that. And there are some of our customers on the cloud side that don't sell travel, and they need fulfillment, they need the hotel, the car, the flight. And we actually have a really good marketplace with exceptionally low travel prices. So overall, the offering is becoming more and more attractive.
All right, Frederic Lalonde, CEO and co-founder of Hopper. Thanks for spending time with us today. We appreciate it. I want to switch gears here now and talk about COVID and the vaccine, because we know the Biden administration announced this week that most Americans will be eligible for a COVID-19 booster shot in September, just a few weeks from now, after the CDC found vaccine effectiveness does decline over time. That is something we expected. Joining us now is Dr. Peter Hotez, co-director of the Center for Vaccine Development at Texas Children's Hospital and dean of the National School of Tropical Medicine at Baylor College of Medicine. We're also joined by our health reporter, Anjali Kamlani. Doctor, thanks so much for being with us. I want to begin with what the Biden administration told us this week. U.S. health officials now recommending we get this booster shot 8 months after our second dose. Do you think this is going to be an annual thing, that we're just going to keep needing the booster shot in the very same way we get the flu vaccine every year?
Actually, I don't. I think we could be, it's not one and done or two and done, but three and done. And here's why. You know, when that vaccine was rolled out in December and January, the first two doses were spaced 3 to 4 weeks apart, 3 weeks for Pfizer BioNTech, 4 weeks for Moderna. And that's because we needed to fully immunize older individuals as fast as possible, because we were losing 3,000 American lives per day, and we had to avert any further tragedy. It was actually a very good decision. The problem was when you did that, there was a trade-off. The trade-off is when you give that kind of rapid pace, a 1-2 vaccination schedule, you don't get very good long-lasting protection, durable protection. So that basically bought us a third immunization right from the beginning, and that's what we're doing now. We're seeing this waning immunity in terms of a decline in terms of preventing infection from over 90% to 40 to 50%. And the worry, I think, is from Health and Human Services is that that's the tip of the spear, and we'll start seeing now a lot of breakthrough hospitalizations, hence the recommendation. But I think the message should be that this third immunization was both predicted and predictable. And it looks like the response to that is quite impressive. After you give that third immunization, I anticipate long-lasting protection, high levels of virus-neutralizing antibody, resilience to the variants, and that may be it. So it's not impossible that we'll need annual boosters. I just don't see us heading that way for now.
Dr. Hotez, I'd love if you could expand on that a little bit, knowing that we can look at the timeline of how the federal government really got to this, starting from early July when we had the CDC, the NIH, and FDA in a joint statement saying that they didn't really see the need for boosters. And, really soon after that, I think is when we started seeing Israel data and UK data coming in. And then following that, we got the announcement yesterday with U.S. health officials saying that there will need to be a booster starting at early as September 20th, even though we're waiting for the process. So looking at it from that perspective, is it too soon to have this conversation about boosters? And what are your thoughts about how the FDA and CDC, especially the advisory committees, are going to be able to handle all of this, considering the announcement has already been made?
Well, a lot to unpack there, Anjali. Let me give you a few ideas. I think, first of all, a number of us in the scientific community anticipated that this is going to be a 3-dose vaccine to give longer lasting protection and greater resilience against the variants. I think what happened, though, when the Pfizer CEO sent out that press release, it caught everybody a little off guard because they said, no, we need to do this now because of the Delta variant, yet there was not underlying supporting data that was presented. Eventually, the data came out, and I think it was the right call. But, without anything to back it, I think it took Health and Human Services off guard, and they said, no, we know we're going to do this, but not right now, and that certainly could have been messaged better. I think also, with regard to yesterday's announcement from the White House, I think they mentioned it, but it needs to be better emphasized that it's not just their call. It's got to go through the agencies, the Food and Drug Administration, possibly the VRBPAC committee, and the CDC and the ACIP committee. And I think it's pretty likely that it will go through. And then it's a matter of trying to figure out how you order it all. I think doing it on the basis of rolling time, meaning if you were the first to get immunized, you should be the first to get vaccinated. All I would say about that is, if you remember that rollout in December and January last year, and then February, it got pretty chaotic. And that's a reminder that our health system can't tolerate a lot of fussiness, can't tolerate a lot of complexity. We need to make it really simple for people, because otherwise things get unglued pretty quickly, and it starts to that in itself becomes destabilizing.
Definitely. Thanks for unpacking all that. I knew you could handle that. The next thing I want to ask you about is the vaccine mandates and passports. I know we're seeing a lot of them pop up. I know in Texas, you're seeing that from the ground, the mask mandates specifically, and how school districts are handling that in defiance of the governor. But I did see an interesting note this morning from an analyst who said that they spoke to an infectious disease expert saying that employee vaccinations and mandates and passports are largely a waste of time, since vaccinated individuals are able to transmit the virus, and especially when we're looking at Delta and its sort of impacts. Your thoughts on that? Is there really a value at this point, considering how infectious this variant is?
Yes, and I think it's not quite true that vaccinated individuals are transmitting the virus as well as unvaccinated. With Delta, there's no question there's a lot more virus in the nasal passages and nasal secretions. So there is more virus shedding than we saw with the previous variants in vaccinated individuals. But I think there's now additional evidence that it's short-lived. And so no question that unvaccinated people are contributing most of the virus into the environment. So I think it is important that we mandate vaccinations. I was hoping we weren't going to have to get there, and I was hoping to hold off as long as possible, in the hopes that vaccinations would accelerate organically, and there'd be this auto correction as people saw their colleagues start getting sick if they were unvaccinated. And that is starting to happen somewhat, but not nearly as fast as needed. So unfortunately, I do think employer mandates are going to be important. The problem, though, is the schools. So we have no state now mandating vaccines in the schools for those 12 and up, and I don't see that happening anytime soon. And that's unfortunate, because if you, especially down here in the South, those individuals 12 to 17, we have vaccination rates around 25%, 3 times higher up in many of the northeastern states. So there's a huge vulnerability there as well. And that's all regulated at the level of the state. And this goes to show you that the federal government has limited reach. They can do a few things like the Veterans Administration, the military, and these are important things, but they don't seem to have that reach. The federal government historically has not had that reach into the schools, the K through 12 schools anyway.
Yeah, it's an ongoing debate for sure for our young people. Dr. Peter Hotez, thanks so much for being with us, and our health reporter Anjali Kamlani for joining us on that conversation.